And on today's show, why retirement plans can be a sudden impact on the tax returns of the charitably minded. Part 2 of this week's series on end-of-the-year charitable giving strategies for 2014 with top producers Mike Kilburn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, LifeSpecs, and Backroom Technician. Let's get down to business. Well, welcome to the show again, Rob, Mike. Boy, I like this having you guys in here at the end of the year. We're going to have to do some more things on the other side of the year and not wait always till the end of the year to do this. But I want to talk about retirement plans. Now, I keep thinking, I'm so sorry, but I think I'm like most advisors. I actually put this plan in for my own income. But you have clients that really don't need this income, and it's causing them actually more taxes. Some people are paying RMDs and they don't even need it. So talk to me about why is this really on our radar when we're talking about end of the year charitable giving?
Well, let's first talk about the charitable IRA rollover, which has just been passed through the House as we tape right now, waiting the president's signature, which should happen. Most people and advisors, right. We hope that he does. That has big impact for the taxpayers in the low bracket and the really high bracket. And first, let's just go through and talk about what the charitable IRA rollover is. It is for those who are in RMD, meaning they're over 70 and a half, it allows them to give directly from their IRA to the charity of their choice. It cannot be a private family foundation, cannot be a donor advised fund. Has to go to an end charity. They must be over 70 and a half, only from an IRA, not a 401k, and it counts as the required minimum distribution. The maximum gift is $100,000, and it's eligible charities, as I just mentioned, and they need a written receipt. Why is this important is that it does not boost up their adjusted gross income. Effectively, when they give from their IRA to charity, it's an above-the-line deduction, which is more valuable than a below-the-line deduction.
All of it, if they went up to $100,000?
They could do that, correct.
In 1 year?
In 1 year.
Wow.
Right. So,
now, not 401k, but they could they tactically roll a 401k into an IRA to accomplish the same?
Most people 70 and a half have already done that.
Okay.
When they're over there, but it's in lieu of the required minimum distributions.
And this, when you say it counts towards RMDs, it counts in reducing them?
Counts as a required distribution. So
if you made a $100,000 contribution this way, and you had to take at least a $50,000 required minimum distribution, you've done it by taking that $100,000.
Exceedingly done it.
Correct.
Okay.
Correct.
All right. So in this tactic, then this is an IRA. We've already got the deduction for it. Now we're able to give it direct. We used to have to go through the shenanigans of going ahead and taking the distribution, paying the tax, and then giving it to the charity.
Well, not paying the tax, but also boosting up your adjusted gross income,
yeah,
right? You boost that up, and then you put it on the Schedule A, which is subject to phase outs on the Schedule A, as we talked about in previous shows. On tax planning, that is. So it's a big benefit here, especially for those who are on Social Security, low income brackets, and those in the high income brackets.
Now, Mike, you deal with a lot of high end clients, but Rob just said this is good for the regular Joe middle class America. I mean, this sounds powerful.
Well, understand he's talking about people must be 70 and a half or older.
Sure.
So we're talking about older clients right now. But this is a good way for them to give because when I first heard of this, I thought, well, why wouldn't you just take it out of the IRA, pay the, now you've got a tax due, but then you get an offsetting tax deduction. And the answer is once you go through the whole tax return, you realize that jumping over all of that, going directly to the charity, will save you big dollars. And Rob's going to show you that. How that
works. So just go through the benefits. It reduces adjusted gross income above the line. It reduces the stealth tax for those who are on the high end, right, in the high brackets. It protects Social Security for those on the lower end.
Before you go far, now remind me, everybody, what the stealth tax is you're talking about.
Well, stealth taxes, there's several of them out there, but the most known one is the Medicare surtax, 3.8%. For those over $250,000 in adjusted gross income, and this is above the line deduction, so it doesn't boost up the adjusted gross income.
And depending upon your income, there's some phase outs of your deductions, which is crazy, but that's a little hidden tax, and there's also a phase out of your personal exemptions above certain level.
So this reduces the income, and those won't be phased out as much. Okay? Give a couple examples here, and we'll start with the low-income retiree, and maybe finish out the show with that. Here we have Bill and Louise. They're mid-70s. They have adjusted gross income of $80,000. Their required minimum distribution, which is a part of the $80,000, is $40,000. They claim the standard deduction, and they pledged this year in their church $40,000 for the building campaign. If they take and give it, so they take the money out of the IRA, they realize it, get a 1099, it goes on their adjusted gross income, and then they give that $40,000 to church and write it off on their Schedule A, the tax liability they're going to pay is $3,900 for that year. That's their total tax liability. Not very high, but still, they will have a positive tax liability. If they took advantage of the charitable IRA rollover and took that $40,000 directly from the IRA to their church, they would not get a 1099. They would not have a Schedule A. They'd still have this the standard deduction, but their tax liability goes to zero. And the reason why is all of a sudden now their Social Security becomes almost tax exempt for them. And that's the big difference right there.
Okay, so at the lower end of income for a senior, this is a way that they want to pledge to their church. They love the church. They've been there for all their life. They want to see it in perpetuity to move
Correct.
on throughout the year. Okay, so I'm saving that $3,964 right off the top.
Correct.
So
Right.
There's a savings right there.
This is an actual case.
Yes.
And then you're saying that my tax liability, but now all of a sudden what happens to my actual Social Security because of this?
Well, Social Security becomes the majority of the benefit becomes tax-free because you just went down your income tax bracket and your taxable income is lower.
How big is this in the smaller middle class America?
This is huge. Yeah.
This is huge.
Well, sure, the
numbers.
clients, when they were sitting there and Rob was actually presenting this to them, they were very pleasantly surprised to see this idea.
We come back from the break, we're going to continue more on this. This is a huge idea. I love that. This is great for the regular Joe giver in America. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Again, we're with Rob O'Dell and Mike Kilborn. We're talking about charitable giving for the end of the year. And now we talked about this first part, which was illuminating to me that we're actually doing this for lower income Americans. But now take me upstairs to the wealthy and the affluent, and the impact must be, I can't even imagine.
Well, it does have big impact. And this is, you go from $3,900 to zero in tax liability for the low one. Let's see what happens with the higher income. And just down the pew from these, Bill and Louise, sits Mike and Norma. They're in their mid-70s. Their adjusted gross income is $350,000. They have $45,000 of itemized deduction, and they pledged $100,000 to that same building campaign that Bill and Louise did. Mm-hmm. So now, if they do a take and give, meaning they take the $100,000 out of the IRA and they give it to church and put it on their Schedule A itemized deductions, their tax liability total for that year is $36,274.
And let me stop you there. There are people that do this.
Oh yeah, absolutely.
Just write the check, know they're going to get a big tax bill, ordinary income tax, and they just do it.
Correct.
Right.
Right.
See, that blows my mind. This is why, as an advisor, these are great tactical issues. Not only end of the year, this should be planning year round, but I love this number. That number is staggering, and you have people that do this because their heart is right. They want to give.
Exactly.
Why can't I make the heart and the economics work?
Right. Now, let's just say Mike and Norma here do not have appreciated assets to give. So if, hopefully the president passes this bill, signs it, if they were to give the required distribution directly from their IRA to the church, their tax liability goes from $36,274 to $31,382, a tax savings of almost $5,000 just by doing that one simple move. Mm-hmm. And why that is their adjusted gross income is less, right? So they're going to be paying less stealth tax. They're going to be paying less tax overall, and they'll have more or less phase out on their Schedule A.
Okay, so the stealth tax, you're going to remind me, well, the stealth tax is the 3.8%?
That's one of them.
That's one of them.
Right.
Okay, so yeah, one of them, yeah. So and this helps out. So we're looking at numbers that reduce exposure to stealth taxes, if I'm hearing you correctly. Correct. It reduces my actual bill due to the IRS from an ordinary income tax point of view. I was able to give to the church that I wanted to do, and I've looked at a really, everybody wins in this issue.
Right, and you even back the clock up, when they contributed this money to the retirement plan years ago, they received 100% income tax deduction. Mm-hmm. So these are pre-tax dollars, and that's what makes it so powerful.
Now, when you show this to clients and they see these numbers, their response is,
why would that?
Yeah, it's like, why wouldn't you do this? Why wouldn't you do this? I mean, I say that to clients sometimes. Why are you hesitating?
Mike, you deal with some of the top affluent clients in the United States, and I'm talking serious uber wealth. This tactic, how many times do you show this?
Oh, they'll make the decision right on the spot, but I show it every time I see the opportunity to.
And how I would think the opportunity must be huge at that level.
It is, and as Mike, I'm going to steal a line from Mike here. The biggest villain here is procrastination, and so what has to happen is the checks have to clear by December 31st. In human nature, a lot of my clients, they'll wait until December to start writing the checks from their IRA directly to charity. Now, this year's been challenging because there's the whisper is they're going to pass it, they're going to pass it. Yeah. Congress just passed it, and hopefully the president signs it soon and becomes law so the checks can go out and be cashed.
And did it pass on a bipartisan vote? Okay, well, maybe the odds are high now.
So they are, because the same thing happened last year and the president signed it. It was actually, how many years is this? 3 years, 4 years now?
It's been 9 years.
9 years?
But it's been off and on, and the bill before Congress is making it permanent, not a patch. So that's a big issue too.
Now, when we're looking at these are for the IRA rollovers. I love this charitable giving using that. When when I think of, I love the old King James phrase, the bequeathing of something. You have that phrase. Yeah. Bequest. What's the difference between that and basic giving? Is there different?
Absolutely. The IRA rollover, charitable rollover, is during life. Bequest is at death.
Ah.
So now, if you were going to give an asset to charity from your estate, what asset would you give? Well, Mike and I would argue that you would give the IRA or something that's pre-taxed. And the reason why is when it goes to that charitable organization,
you get a dollar. You get the dollar goes all the way over and they get a full dollar.
Mm-hmm.
But if you if you don't do that, you give it from some other area of your estate, your assets, then you've got to pay the taxes on the IRA's dollar that you take out.
And if the IRA goes to the children, they pay tax on it. The charity will not pay tax on it. And if you own stocks, they get a step up in basis upon death. So it's the most tax efficient asset to leave at death to charity.
Well, when I'm looking at, give me an example of what I'm going to give away at my death. Okay. And I'm assuming that the reasons why I'm choosing this, making this selection, is because there's certain things I still want maybe when I'm alive.
Right. Right.
But we're not doing any income plays yet. We're still just giving money to the charity yet. Yeah, we've got that far.
Right.
I've got a good example. I had a client, she had $2.5 million in her IRA, and we figured about a 6% income, which was how it was working. And from that, we were able to pay the tax and then purchase a life insurance policy on her life that created $5 million for her children. Think about that. They would get $2.5 million less the income tax, less the estate tax, but now they're going to get $5 million income and estate tax free. And at her death, the $2.5 million went to charity. So during her life, the income from the $2.5 million paid for the life insurance premium, and so now the kids are way better off, double, and the charity's better off at her death.
I think most people, when you're looking at this replacement, the beneficiaries usually show up and say, "Well, I really take a dim view of you giving my inheritance away." But you just said I just doubled it.
Way better.
And tax advantage.
In fact, it was more than double, because by the time you get to the net, I think they were out of $2.5 million, they were going to net 800 and some odd thousand after income tax and estate tax, and now they're getting $5 million income and estate tax free.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant, and we'll see you tomorrow.